Hello everyone, this is Harjinder, and in this video we're going to talk about topic 13, changes in ownership. Just to remind ourselves, the accounting models for investments in other companies' shares. When no significant influence exists, we treat the investment as a passive investment and will account for them as either fair value through profit or loss or fair value through other comprehensive income elect. Once significant influence is obtained, we must change over to the equity method. Once control is obtained, the parent company must consolidate the financial information pertaining to the subsidiary into its own financial information. So let's take a look at a situation where there's a change in ownership, either resulting in an acquisition of or loss of significant influence. So on acquiring significant influence, any shares that the investor may have earlier owned in the associate must be remeasured to fair value, with any gain or loss to be recorded in profit or loss. The obtaining of significant influence will require a change in the accounting method from fair value to equity method. An acquisition differential and goodwill must be calculated on obtaining significant influence. And every subsequent purchase or sale, while maintaining significant influence, will trigger a separate calculation of acquisition differential and goodwill. So for example, if an investor obtains significant influence over an associate by purchasing 25% of the outstanding common shares, and later on were to buy another 20%, 25 plus 20, 45% of ownership. And if that's not enough to get control, then the 20% of the chunk of shares that are purchased, the investor must calculate a separate acquisition differential and goodwill on that particular acquisition. If significant influence is lost, then any shares that are still owned afterwards must be remeasured to fair value, with any resulting gain or loss to be recorded in profit or loss, and the accounting model will change back from the equity method to fair value profit or loss. Looking at acquisition or loss of control. On obtaining control, the parent company, any shares that the parent company may have owned earlier in the subsidiary are to be remeasured to fair value, with a gain or loss recorded in profit or loss. The accounting method will now change from the equity method over to consolidation. And in this case, a brand new calculation is done for acquisition differential and goodwill. If the parent company were to lose control, then any shares that it continues to own after the fact are to be remeasured to fair value, with a gain or loss to be recorded in profit or loss. And the accounting method must be changed over to the equity method if significant influence is retained, or to fair value profit or loss if the investment becomes a passive investment. Block acquisitions relate to a situation where the parent may have obtained control over a subsidiary through a series of purchases, starting with a small purchase, gradually building up stake, obtaining significant influence, and finally obtaining control. The accounting methods will also have reflected the nature of the investment at each stage. Every time that there is a change in the accounting method, for example, from fair value profit or loss to the equity method, or from the equity method to consolidation, the investment account is remeasured to fair value. Next, we look at changes in the parent's ownership. So while maintaining control, there can be changes increase or decrease in the parent's ownership percentage in the subsidiary. There are four ways in which changes can occur in the percentage ownership without any loss of control. The parent's percentage ownership can increase if the parent was to buy shares of the subsidiary, additional shares from other shareholders who are essentially part of non-controlling interest, or if the subsidiary was to buy back shares from the public. Once that happens, the shares bought back by the subsidiary are canceled, and this results in a concentration of the parent's ownership. There can be a decrease in the parent's ownership as well if the parent were to sell some of its shares in the subsidiary out in the open market. The new buyers will become non-controlling interest. So the percentage ownership of non-controlling interest increases as a result of that. Or if the subsidiary were to issue additional shares out to the public without the parent buying any more. These kinds of transactions are treated as transactions with shareholders. The subsidiary's adjusted net book value is used to compute the value of the transaction. The portion of the investment increase or decrease resulting from the above transactions. And if there is any kind of difference between consideration received or paid and the value of investment decrease or increase, that gain or loss is not recorded as such as a gain or loss, but it's rather recorded in retained earnings for loss and in contributed surplus for a gain. There is no recalculation of acquisition differential and goodwill, though. Because of the fact that the parent company continues to be in control, we do not recalculate acquisition differential and goodwill. Let's take a look at these four ways in which the parent's ownership changes in more detail. First, let's talk about the parent selling shares in the subsidiary. This will result in a reduction in the parent's percentage ownership and an increase in the percentage ownership of non-controlling interests. These transactions are considered or treated in a manner similar to transactions with shareholders. So what that means is we calculate the book value of the investment sold using the book value of the subsidiary plus any unamortized acquisition differential adjusted for unrealized upstream intercompany profits or losses. This is a procedure similar to step 9 calculation of non-controlling interest. If there's any gain or loss from the parent company's perspective, we credit the gain to contributed surplus, debit the loss to retained earnings. Basically, the gain or loss is booked through shareholders' equity, so long as the parent company retains control over the subsidiary. Now, if it were to happen that the parent loses control over the subsidiary because of an extensive sale of its holdings, then of course, the loss of control would mean the accounting model needs to change, and that will then result in the remeasurement of the remaining shares, if any, and the resultant gain or loss is actually recorded in the parent company's net income. If the parent were to buy shares in the subsidiary, this would be the opposite of the earlier situation. It results in an increase in the parent's percentage ownership and a reduction in the percentage owned by non-controlling interest. This transaction is also treated in manner similar to transactions with shareholders. The book value of the investment purchased is calculated using the book value of the subsidiary, similarly manner similar to step 9 calculation of non-controlling interest. And if there is any kind of gain or loss from the parent company's perspective, we record it through shareholders' equity, i.e. the gain going through contributed surplus, the loss through retained earnings. If the subsidiary were to issue additional shares to the public, the transaction will result in a decrease in the percentage ownership of the parent and a corresponding increase in the percentage owned by non-controlling interest. However, a thing to keep in mind here is that this transaction will also result in an increase in the value of the subsidiary because the additional shares bring in cash or other consideration. So what we do in this case is we calculate the value of the parent's investment before and after the share issuance by the subsidiary. And if there's any increase in value, it results in a gain for the parent. A decrease will indicate a loss. This gain or loss is recorded through shareholders' equity, the gain going through contributed surplus, loss going through retained earnings. Finally, let's take a look at a situation where the subsidiary buys back shares from the public. Now, this will result in an increase in the parent's percentage ownership with a corresponding decrease in the percentage owned by non-controlling interests. However, do keep in mind that the transaction will result in a decrease in the value of the subsidiary due to the reduction in cash or other consideration paid for the repurchased shares. So in this case, we again calculate the value of the parent company's investment, both before and after the share reacquisition. Should there be an increase in value, rare, but should that be the case, it will result in a gain for the parent. A decrease is typically the case, and that would indicate a loss. Whatever the matter, the gain or loss is recorded through shareholders' equity, with the gain being credited to contributed surplus and the loss recorded through retained earnings.